Thanks so much for tuning into this earnings conversation with the management of IDFC FIRST Bank. It's the stock of the morning, and by virtue of the fact that in Q4 they have posted, of course, a very strong Q4. They've beaten the PPOP and PAT forecasts quite handsomely. The guidance seems to be good, but it's coming at a point of time wherein most analysts believe that post Q4 we are looking at a period of life post peak net interest margins. If that is indeed the case, how does IDFC FIRST Bank expect to perform both on the growth side as well as on the profitability metrics and more over the course of FY24 after a very strong FY23? That's the first question to Mr. V. Vaidyanathan as he joins us on the show. Mr. Vaidyanathan, great having you. Thanks for joining in and congratulations on a good quarter and a good year. Can you first actually pencil out for me? Sorry, I'm changing my first question. Can you pencil out for us what went right in the quarter? And if you look back at FY23, what was a standout piece for you as a banker?
What went really right for us is the asset quality. I think we always guide for gross NPA of 2% on the retail side, which is, by the way, biggest part of a book. And we came in at 1.55. We guided for net NPA of 1%. We came in at 0.55. And we guided for credit cost initially of 2%. Then we improved the guidance to 1.5. We came in at 1.2 or 1.3. So I think let me standout feature has been, of course, asset quality. And of course, the thing that, helped, I'd imagine, on the profitability front is that the repo rates went up. So the pass on to customers happened. But the catch up, the full cost of funds did not get impacted proportionately. So I think we got a bit of an advantage also by the ecosystem.
How strong is the ecosystem, one, for the loan growth? And I think that seems to be really not an issue, but profitable loan growth in light of the fact that most people believe that we might be past peak NIMs, and with the RBI slated to, or having done what it has done and slated to continue on that path as the next 4 or 6 quarters go by, profitable growth might not be as easy to achieve, so to say.
Well, that's not true, actually. When we run an institution, or rather when we build an institution, we should look through cycles and we should look long. So when you look long, we've seen the worst of times, let me say, in the last 4 years. We saw some bad loan cycles, we saw infrastructure, then we saw weaving the system, then we saw it, COVID, and then we saw a benign 24 or 23. We've seen everything. And in the future also we'll have ups and downs. The more important thing to note is, do we have a fundamental business model that is a strong business model with good quality, and does it have good earning potential? Is the fundamental liability franchise coming strong? These are the important things to answer, and I think, or to think about. And I think there we are feeling quite strong.
One of your peers, if you will, on the NBFC side, of course, you're a banker, but an NBFC, if you will, and if you can call both institutions set of peers, so to say, spoke fairly extensively about the fact that while retail loans or loans at large are not an issue currently, there is a bit of quote unquote recklessness, not verbatim, but I'm just using that term, by the system at large, and hopefully it doesn't come back to bite the system over the course of the next 4 to 8 quarters. I mean, maybe from not your perspective, but from a perspective of the space at large, do you reckon that loan growth is happening at a slightly quicker pace than what could be desirable, or no such qualms at your end?
See, the way to think about it is that right now India is developing a large number of ecosystems that are very good guardrails. What do you mean by that is basically bureaus have come. People are very sensitive about the bureau scores. And that is one big factor. There are 4 credit bureaus with, like a lot of maybe 600 million trade lines and all that, and records. Number 2, the ability to evaluate cash flow in the system is much better. Not long ago, people used to lend on the basis of income tax return, but income tax return, is not cash flow. Income tax is income. So now we are able to evaluate cash flow and lend. So I think that a collection percentage has become good for the country overall, for the system. I'd say therefore things have become better in a structural sense. In the business, you should always be very careful. If you take the eyes off the ball, one wicket will fall. So we should be always very careful. But I think the conditions have become better.
Okay. Now, about your guidance, I'll start off with the point that I actually asked you first, then go on to the ROA, ROE too. But first, the net interest margins. From 6.4% that you've had, right, for Q3 FY23 or what you reported for the year at large, you're getting to what, 5.5, circa 5.5 for FY24. What goes behind this? Because that kind of ties in with the question that I was asking earlier, that how easy or difficult would it be to grow at the pace that you're growing while trying to maintain the margins that you've clocked in for an average of FY23 or at the peak of FY23, whichever quarter it may have been.
No, I know. I think the report is referring to the 5.5 is a bit of an errata. So just leave that aside. The more guidance expected from us in terms of from us is NIMs of about 6.4, 6.5%. Stay in that ballpark over the next 1 year. And I think the important thing is not so much net interest margin. The most important item is, if you have this NIM, what is your credit cost? Is your asset quality holding up?
Right.
And is it strong? That's more important. Now, on that front, we keep it very simple. Like I told the gross and net numbers, I won't repeat them. But the credit cost numbers, if we keep in the, we expect to keep it in the guidance range. In fact, lesser than guidance range. So that's more really important. But coming back to the NIM, like I told you, I gave you my broad picture. It has two factors that are going to play. One is, of course, the cost of deposits will catch up this year. So to that extent, it has an impact on NIM. On the other hand, specifically for us, there is a lot of legacy borrowings that are coming for repayment, which are priced at 8.9%. We're going to replace them at 5-point-something%. So they too offset with each other.
Okay. So that kind of is a bit of a tailwind for you for FY24. But I'm just trying to understand the broader picture, Mr. Vaidyanathan. The fact that the Reserve Bank of India goes ahead and reduces rates as time comes by, and with everybody vying for a share of deposits at a point of time when lending is not an issue but deposits are, could there be a strain on overall deposit growth? You alluded to in that previous answer, but tell me for the system at large, what's your sense?
Yes, if you see the liquidity in the system, it's quite, let me say, it's not surplus anymore, it's not flush anymore. It used to be 8 lakh crores at one point of time, probably like 1.5 lakh crore now. So, and credit growth is coming, deposits look so slow for the system, so naturally there will be, a lot of pressure for deposits. I think it is to be expected. It is a cycle that ecosystem go through. From our side, let me just say that we have big opportunities. Our biggest opportunity is the fact that we are coming from a low base, and we are we say early stage. So for us, you open more locations, you get deposits. You open more branches, you get deposits. You launch a current account business. By the way, one of our, let me say, weaker spots, so to say, is our current account business. We have lesser proportion of current account as a percentage of CASA. So we're going to power up current account business. So that is an opportunity for us. Our brand is a very big opportunity. Neeraj, I don't know if you experience this or not, but all our employees, when we visit, I meet many people at our branches, etc. They all tell us that people really respect our brand and trust in it. So there are things going our way.
Okay. And what are the factors that go behind what the market seems to have liked the most, which is the guidance on ROA and ROE? Because there are skeptics. The report that you referred that I'm reading about also expresses some skepticism around that, which you would have noticed too. So what goes behind this guidance, and what is the downside risk to both of these numbers?
No, they should, first of all, I say they should always be some skeptics. Okay, it keeps us there and keeps us, let me say, wanting to prove them wrong. Earlier, it used to be the Morgan Stanley report, which used to be always negative on us. Fine, something to, that's fine. But coming back to, I don't know the specific portion you're referring to, but more specifically, we feel that our guidance on ROA, ROE, we are ahead of our guidance. We guided for Q4 ROE of 10%. Remember, you're coming from 0. So 10 is not great, but think of the trajectory is very good.
Yeah.
We're coming, 0, we're now 10. Now we're 12. Even without the one-off income, we had the one-off income. Even if you take it out, it's still like 12. So we're running ahead. Now we have guided for FY25 guidance for of 13 to 15%. I feel we'll go to the upper end of that guidance, not the lower end, and certainly for the exit quarter. So skeptics are there, and it's okay. We'll do better.
Okay. So I'll just qualify the point that a Nuvama report mentions that they speak about your guidance and then say that they believe that one of the incremental drivers or big drivers of this higher ROE assumptions would be the cost to income ratio coming off as you've guided by FY25. But could there be a pickle out there, considering that competition is making very high investments and therefore it might be difficult to lower the cost to income ratio from levels that it is at to levels that you are guiding towards? Would you comment on that?
No, people who have those concerns are also fair in their concerns because, they are not insiders. I'm an insider. I'm seeing the bank evolve. So obviously I have a much better picture. I have more confidence in the bank. They're outsiders and they may have their concerns. They've seen failures elsewhere or the people not living up to guidance, etc. But my answer to them would be that every one of the guidance we give, we have met or we are on track. But specifically in cost income ratio, definitely we have a few levers because on the income front, we are yet not, touching all the buttons. For example, our cross-sell percentages could improve from where we are today. Our current account business could grow and that could give us income. Cash management business could grow, that could give us income, and we are early stage there. So there are wealth management business. So there are a lot of income yet to come. And cost will come down as a proportion, definitely.
So asset quality improves, cost comes down, ROE go up, loan growth remains positive. It almost seems to be a blue sky scenario, Mr. Vaidyanathan, in some sense.
No, but the thing is that we are consistent. You see the track record for the last 5 years. Is there any item that is not consistent? We said we'll bring down infrastructure, we brought it down. We said we'll not grow the loan book for 3 years because we want to play safe. We want deposits, we do it. We said we'll we'll improve asset quality, we did it. Every issue of the past, we looked in the eye and we dealt with it. We never tried to find cute interpretations of things. So it's consistency. And you will see us being consistent going forward also. We won't change track this way or that way.
Okay. My final question, at the start of FY24, when almost every global expert that I speak to talks about the kind of growth that India will deliver over the course of the next few years. We've spoken a lot about the quarter, maybe spoken a bit about FY24. Tell us if you have a 3-year plan in your mind about where you are versus where IDFC FIRST Bank could be like. Would you hazard a guess?
First of all, I think that the India itself is going to be in a very, very good patch in the next few years because of a massive amount of organized. Everything is becoming more unorganized to organized. Maybe the ecosystem itself is playing a role in that. Number 2, massive amount of digitization is happening. And remember, digitization plus formalization makes for a terrific combination because it enables financial services in a big way. So that is a broad context in which things are playing out. Now, in that context, I would say that I wouldn't like to expectations too much, anything like that. I'd like to say that we'll be a stable, steady player. Our deposits will do well. Our loan growth will do well. Our asset quality our belief will actually get better from here. That's our internal belief based on the trends we're seeing because our SMA numbers are very low. So SMA is low means NPA will be low. So asset quality will get better. So you should expect a steady quality performance from us, and you should not expect any yo-yo from us.
Wow. Well, all the best for all of that and more, Mr. Vaidyanathan. Thank you so much for taking the time out and speaking to us today. Congratulations on a good year and a good quarter, and all the best for many more.